Good afternoon, everyone, and thank you for finding time out of your busy Tuesday to meet us here for this webinar, Financing for Real Estate in 2021. My name's Tom Ahola. I'm a realtor and advisor here at Marshall Reddick Real Estate, and I'm joined today by Reed Hazard, who's been not just a good friend, but with us for over 17 years and really knows what he's talking about. So you're in for some good info today. Right. Got a couple people still trickle in here, so we'll get into this. All right. All right, first things first, Marshall Reddick Real Estate. If this is your first time joining us here, this is a little bit of preliminary information about exactly what we do here. Marshall Reddick is a real estate brokerage that's in-state and out-of-state for both residential and investment purposes, listings and sales. So even if that's selling your home or buying your home or any investment properties in-state and out-of-state, we can help you with that. We are also a private money lender. So for all of those loans that Reed doesn't do, we do loans there for bridge loans, construction loans, anything that you would need a private money lender for. We also sell the mortgage notes, which is actually a very interesting way to invest in real estate, but we'll leave that in depth for another day. And last but not least, to round off the trifecta of real estate, we also do property management, because any good real estate investor knows that you can buy a great deal, but if it's not managed effectively, it's not so much a great deal anymore. So we have great teams set up in each of these markets to help manage your assets and keep it as a smart investment. Here's a little blurb down here that I particularly enjoy. We make it possible to purchase residential real estate in carefully selected areas of the United States. Our organization provides real estate brokers, contractors, property managers, and access to top resources such as lenders, i.e. Reed, CPAs, insurance agents, attorneys, and much more. Marshall Reddick's been around for many years, and with that comes great relationships with a lot of different vendors and folks who are investment-minded real estate people, and it really does show in the people who we work with. Now, a little bit about myself. My name's Tom Ahola. As I said, I'm a realtor and advisor here. I have assisted clients both in-state and out-of-state with single-family and multifamily transactions. Now, what that looks like is duplex, triplex, fourplex, again, both in-state and out-of-state. Naturally, I'm a California licensed realtor, have been for about 4 years now. I actually went back to college, and I didn't know this, but you can get a degree in real estate. I come from a family of educators, so fitting in here at Marshall Reddick has been very natural, seeing that we are very education oriented and it's a great learning environment. Now, what to expect from a consultation with an advisor. So next steps, if you're interested in taking the jump into real estate investing, you can schedule a consultation. First things first is goal setting. We look at exactly what you're looking for, your 6-month, 12-month, 5-year, 10-year goals, and help you set those and hit those. We evaluate your options, what that investment looks like. We look at what your investment goals are and how to achieve them. Decide on a time frame, whether that's 30 days, 60 days, 180 days, or 2 years down the line. How many properties you're looking to acquire, what markets, and so on and so forth. And the next is setting your criteria. By that, it means what type of property you're looking for, be that single family, multifamily, or if you're even looking to scale up into something larger. Where we then identify the market, as in looking for appreciation or cash flow or specific markets for certain purposes. And last but not least, we introduce you to all the key players. So your lender or the local agents or 1031 accommodator, whoever that might be, to help you in your real estate transaction. Here's a short list of the markets that we do the majority of our business in. Phoenix, a lot of different cities here in California, Fort Myers, Florida, Tampa, Boise, Indianapolis, Las Vegas, Clarksville, Memphis, Tennessee, Austin, Dallas, and San Antonio. This is just a short list. We do have referral partners in some other places as well, but this is markets that we've selected that we like to do business in. Now, why have we selected these markets? Well, here's why. Number one always falls on the job market. We always like to select cities that have a very strong economy. We look at cities that also have a good vacancy factor. We want places where we're going to see little and low vacancy rates. We also look for cities with economic diversity. Now, what does that mean? We look for cities with manufacturing, with medical, with military, with education. We look at different markets so that if there was to have any kind of issue with one market or the other, you're not looking at a small manufacturing town where the plant shuts down. Housing affordability. This is also very important as well. For quality of life, we want a place where we can have tenants who can afford to pay their rents, and of course the low purchase price for acquisitions on our side as well. We also look at landlord-friendly states. I'm looking at you, California. If anybody owns any investment properties here in California, we've definitely experienced this in the past few years of dealing with all kinds of issues with tenancy and all kinds of eviction problems. We look at states that are landlord friendly, where you can manage your asset how you choose to manage it. We also look for a strong education, i.e. what that means is a market that we know very well, that we've done business in, that we know what jobs are in the market, what the vacancy is, and kind of everything we just talked about. We do our research almost quarterly on this one. And then we also look for markets with reliable property management. And that really means that we have our Marshall Reddick real estate property management teams set up to help take care of your asset as soon as you acquire it. Now that's the short end of it really here of what to expect from us at Marshall Reddick and me as an advisor. Let me make a short introduction to Reed Hazard, who has been not just our preferred lender, but he's been with us for, as I said, over 17 years and is extremely knowledgeable and a great guy all around and a good friend of mine. So take it away, Reed.
Thanks so much, Thomas, and great job. Hi, everybody. Great to be here on the call. My immune system's a little bit down, as I'm sure many people's are, because we've been on the COVID restriction lockdown for a long time, and even as it's opened back up, haven't been sick in a while. And this cold I've had has been really lagging on me for about 2 weeks. So if you hear that in my voice, I'm going to get through some of these slides with as much detail as I can, but I may need to stop for a minute at some point. A little bit about me. I've been doing mortgage loans since I was 19 years old. I'm 35, and I've now been within Marshall Reddick for 17 years. I started my career with Marshall Reddick, setting up the seminars and really just doing logistics. And I really found a passion for it right away. And I ended up I started working with one of the lending companies at the time, and then started doing loans and going to all the different seminars. So some of you may have seen me at the live events that we host over the years. But yeah, just love this company, love what we do. And I've been a loan officer now this is my 17th year. I'm nationally ranked in the top 100 loan originators nationwide. So definitely do a ton of business and just love what we do. I specialize mainly in purchase and refinance loans for conventional loans, jumbo loans, VA loans, FHA loans, and I'm going to cover those products tonight. I'm also a seasoned real estate investor. I bought my first property when I was 19. I've been able to exchange into better properties over the years. I've got 7 properties now. They're all located in very, very great areas. All the areas that Marshall Reddick sells property in, I definitely stand by. These are the best markets in the U.S. for investing. But I own property in Austin, San Antonio, and in Orange County. I've worked with over 1,000 Marshall Reddick clients. I think last year I did about 200 loans for the Marshall Reddick group. So definitely just doing a lot of business with Marshall Reddick, and just, again, love this company. And I'm federally and state licensed to lend in California, Oregon, Nevada, Arizona, Texas, Tennessee, Indiana, Kentucky, and Florida. And then I'm also branch licensed in Idaho, Hawaii, Colorado, and Washington. One of my loan officers, Lisa Nesper, assists me with the Marshall Reddick group, and she's personally licensed in Colorado, Hawaii, Washington, and Idaho, so we can handle those states internally in my branch. and my company's licensed in all 50 states. So if you're doing a deal in anywhere in the nation, I can get a hold of a top producing loan officer that's fantastic for you, and I can make a warm introduction anytime. So again, we can handle all 50 states, but this is where I personally work. Oh, and that's my beautiful wife, Chelsea, and our 2 kids live in Pierce. And yeah, just definitely a family man. And my little boy is now 2 years old. My little girl's 5. And man, the years do go by fast. So trying to get as much time with them as possible. Some of the information I'm going to be covering tonight, getting pre-approved, really what does that consist of versus like a pre-qualification. They're definitely different, and I'm going to dive into that and how that'll give you an edge on the market. Best programs available for primary residence and investment property financing, so I'm going to be covering that. Really just lowest interest rates with the lowest down payment requirements, conventional loans, FHA loans, VA loans, jumbo loans. What makes a loan a jumbo loan? What's changed since COVID-19? And last year when I did this presentation, I had some good insight on what had changed at that moment because we were really in the heat of COVID-19. And tonight I'm going to cover what's kind of changed back to the good old way of doing it, and then what things have kind of stood in place. I'm going to be going over private financing options for those that can't qualify for conventional financing. And then I'm going to do a quick market update and pretty much just how COVID has really affected the market and affected interest rates. Also really what to expect for the next few years. So getting pre-approved. In order to get pre-approved, you have to complete a loan application. I've got a great online application through my website at readhazard.com. It's a smart app system. It's very easy. It takes probably 10 minutes to get an application done. We do need to run your credit. You do a full credit hit when you do a pre-approval. To do a pre-qualification, we can have you guys run your own credit. Like if you're not going to buy for 6 to 12 months and you just want to have an idea of what you'll need to do to get there, we'll have a consultation call and I'll give you all that data. But when you're ready to start shopping, this is when you've got to get your credit ran. You got to do it right. It'll allow us to do a DU approval, which is a desktop underwritten approval where we actually run your loan through the automated underwriting system with Fannie Mae or Freddie Mac or wherever we're going to sell the loan to. And that will give you a formal loan number, and it will give us all the information that we need so that we can really process a true pre-approval. We also will ask for income and asset documentation, so like tax returns for the past 2 years, 2 months bank statements for any accounts that you're planning on using for the purchase. You'll need mortgage statements for any properties that you already own, homeowners insurance declarations pages for those properties, and then 30 days of recent pay stubs. That's usually what we ask for. If you're self-employed, we'll just request 2 years most recent tax returns, and you'll have to get a profit and loss statement for the year to date. If you're on an extension for last year, you need a full year P&L for last year, and then you need a current year-to-date P&L. But obviously, if you don't pay yourself with pay stubs or if it's a little bit unconventional, again, we can just go off the P&L and off the tax returns. After we get all these documents in the application, my pre-underwriter is Mike Lynch. He's been in the business for 26 years. He's phenomenal. And he's like an underwriter on steroids. And for any of you that don't know, the underwriter is the person that's going to approve your loan. They're going to review all your documentation for accuracy. They're going to dig in there and try to make sure that there's nothing that they're missing, like a foreclosure or a short sale. And so Mike is my pre-underwriter. Before it goes to the final underwriter after you're in contract on a deal, that's later. Mike is an underwriter. He's a DE underwriter. So he'll review all of your documentation. That way we can get it done pretty quickly. If it had to go to a real underwriter, right, it would probably take 3 to 5 days minimum, and we'd have to have you sign preliminary loan disclosures. We don't want to have to do that, so we just have Mike do the pre-approvals, and then my other underwriter, Dave, is like a Mike on steroids. He's the best in the business, and he reviews all of the a little bit more difficult files that are very intricate. We have buyers that have 30 investment properties, right? This is a big file to review. So I'm definitely fully staffed to make sure that this is done correctly. And what this will do is this will get you pre-approved so that you can prepare a very competitive offer. In certain markets in the country right now, it takes a very long time to get an appraisal. Austin, Texas is one of those states. I mean, it can take, you can do a 45-day escrow now there because it can take 3 to 4 weeks just to get the appraiser out there. In Orange County, it's a very hot market, but we're able to get appraisals done much faster. In Orange County, for example, if you wanted to get pre-approved to buy a primary residence, we could do a 21-day escrow, even an 18-day escrow. And when you go and you submit that offer with your Marcia Reddick Realtor, and then the seller's agent, first thing they do, they look at who the lender is. They Google my name, they see hundreds of 5-star reviews, they see that I'm a top guy in the country, they call me. A lot of times I'll call them if I don't hear from them so we can have a conversation. I don't give too much of your personal information out. I just let them know that you're fully approved, that we've done a DU approval. I let them know that your assets are great, everything's looking great on the deal, so that they know that it's going to close. When you do that with a short turn time close, like a 21-day escrow, and there's 5 other offers on the property, your offer is going to stand out. 1, because the lender called and the lender talked to them. 2, you have a good lender. 3, the offer is written correctly. Marcia Reddick Realtors are very skilled in writing their offers. It's part of the criteria that their CEO and that his partner have put together so that these offers are written just amazing, so that they stand out. And then again, you have your pre-approval letter. They've talked to me, and we know that we can close fast. In some cases, this is just as good as an all-cash offer. So this is why getting pre-approved is important. The way that some banks do it is they just run your credit and take an application and send you out a letter. And they don't review anything ahead of time. Or they'll ask you for tax returns and a couple items, but they're being reviewed by the loan officer. Loan officers are great at selling, but being an underwriter is, that's why you have to get an underwriter degree, so to speak, right? You have to get these designations because that's what your job is to underwrite the loans. My job as a loan officer is to understand loans, to help with mortgage planning, to help you understand what your payments are going to be, to help you understand the general logistics of the loan process. But it's not, loan officers and underwriters are different creatures, really. And the way that you look at a file as an underwriter is way different than how a loan officer looks at it. So again, most loan officers are going to, request some documents. And even if they request everything that I mentioned, if they're the one doing the DU and doing the pre-approval, it's not the same as an underwriter actually looking at your file. But again, most lenders don't even go that far. They'll just do an application, credit, ask for some pay stubs and bank statements, and then give you a pre-approval letter. And the thing that can happen is if they miss something important, if the details about, maybe you haven't been at the current job for a certain amount of time that's needed for that loan program, and then you get into escrow, and then you're 2 weeks into it, and then the deal blows up, that's where it can hurt. So even if you know that you're qualified, it's extremely important to get pre-approved the right way. Another thing is it will show you what your true buying power is. So if you want to put together a plan to build a portfolio of 10 rental properties over the next 10 years, you need to know how much that you qualify for. You need to know how much money you're going to need to do that. This will help you to really create a plan. From the investment side, getting pre-approved is an absolute mandatory when you're going to build your portfolio. It's just going to give you so much data that you need. Some people are just looking to buy a primary residence or are not going to buy investment property. And even then, it will at least show you what you qualify for. It'll let your realtor know what you qualify for, right, so that they're shopping for properties within your budget. And it will also allow you to really see what those payments are going to look like. When you buy a home, it's not just principal and interest on your loan that you're paying back. You're paying property taxes, homeowners insurance. You may have an HOA. You may need flood insurance. So getting a true estimate of what your total monthly payment's going to look like is it's really helpful, and it's going to help you to shop for the right property. A couple of the commonly asked questions: how long is the pre-approval good for? 90 to 120 days. The credit report during COVID was only good. It dropped down to 30 days. We had to redo a credit report every 30 days. Now, basically what I'm seeing is that 120 days is acceptable. After you get into escrow, though, on the new purchase, we will need to rerun the credit again if it's outside of that time frame. If you're not looking to buy for the next 4 to 6 months, you just want to do some mortgage planning. Like I said, we don't have to run credit yet. We also have the ability to do a soft pull So just when we do our consultation, or if you have any questions, we can cover it then. But again, getting pre-approved is really important for if you're ready to get started now. How long will the process take? If your file is very simple, you don't already own multiple investment properties and you're not self-employed, within 24 hours we can have you pre-approved. If you're the latter, then maybe 2 to 3 days, sometimes 4 or 5 days. We just had a client that had literally 30 investment properties. It was a lot to review, and that took about 5 days to get that done. And then what if I want to purchase more than one property? I have a client right now that lives in Australia that we're helping do a 1031 exchange, and we're buying 5 properties at once. Okay, so his income is all derived in the United States. He lives in Australia, and we're doing 5 deals at the same time. So the most we've ever done is 8 at the same time. So yeah, I mean, doing multiple deals, even in multiple markets at the same time. He's buying 3 in Florida and 2 in Texas. So again, we're handling all of that, and we do it well. Okay, so what is the qualification of a loan built on? It's built on your ability to repay the loan. And how we get the max that you qualify for is we find out what your debt to income ratio is. And then I'm going to cover how high that you can go in debt to income ratio on the next few slides. So an easy way to calculate your own debt to income ratio is you get the monthly minimum payments on any credit cards that you have. You owe $500, but the minimum payment's $50. We go off the minimum payment. Any auto loans, any mortgages, including property taxes and insurance, student loans, any other loan that's on your credit, an installment loan. We add all those payments up, and then we divide that payment into your gross monthly income. So for example, if you made $10,000 a month, the home that you're going to buy is $4,000 a month, and you have a $500 auto loan, no credit card debt. Your total monthly debts are $4,500. $4,500 divided into 10,000 would be 45%. You'd have a 45% debt to income ratio. Okay, so that's how you calculate debt to income. Debts that are not counted against your DTI are auto or health insurance, cell phone bills, utilities. If you lend money to a family or friend, it's not recorded with the county. We don't know about that. Business loans that are tied to the business, we can show that they're tied to the business. We can omit that debt. So mainly just things that are on your personal credit report. What are the debt to income ratio requirements for investment property? It's based on credit score. The max debt to income ratio you can go to is 49.99%. If your mid-FICO score is 640 to 660, you're going to get capped at 43. If your middle credit score, remember we have 3 credit scores, TransUnion, Experian, and Equifax. We go off of the middle score, okay? 660 to 680, 45% max. 680 to 700, 45% max. But if you're above a 700 mid score, we can go all the way to 49.99%. Max loan amounts for Orange County. Nationwide, the conventional Fannie Mae, Freddie Mac loan limit has now been bumped up to $548,250. In 2016, it was $417,000. And it was actually $417,000 all the way from 2006 to 2016, because real estate had a big bump in the road, right, in between that time frame. But as the jobs market got back to where it needed to be, then we saw Fannie Mae start raising their loan limit. And so now you can go to $548,250. Why is that important? If you're buying a primary residence in a market that's at $548,250, you can now go 3% down to a $548,250 loan amount. In certain markets in the United States, there's what's called high-cost markets. Orange County, Los Angeles County, San Diego County, areas of New York. There's quite a few areas that you can go to a higher loan amount than $548,250. In Orange County, for example, you can go to an $822,375 loan amount. You can do that with 5% down. You can't go 3% down on what's called the Fannie Mae high balance loan. That's above $548,000. But you can go 5% down. That to me is unbelievable. To be able to go 5% down on an $822 loan amount can pretty much get you into a really good property in Orange County. and really in a lot of the surrounding markets. San Diego's capped a little bit lower. Los Angeles is capped at 822, 375. And why do we go conventional financing? Lowest interest rates with the lowest down payment requirements. If you're buying an investment property, 25% down is going to give you the best interest rates. But you can even go as little as 15% down. I don't advise that. I always advise a 25% down payment. 20 is okay. The rates are a little higher than 25. It's a good use of leverage, but you really got to be buying a property, in my opinion, that has some cash flow. So 25% down is really the sweet spot. The rates are really the best. You don't really get a lower rate for putting an extra 5 or 10% down versus 25. So 25 really is the sweet spot. But for a primary residence, you're buying a starter home, you got a great job, 5% down conventional loan or 10% down conventional loan is phenomenal. And you're going to have the best interest rates for higher credit tier borrowers. So anybody that's above a 700 mid credit score, you're usually going to go with a conventional loan. If you're below 700, and if it's for a reason, like not just that you have a lot of credit card debt that's revolving, you could always pay that down and we can get the scores up. But if you were late on some payments a year ago or 2 years ago and it's still affecting your scores and there's really no way to get them up, then there's other loan programs I'm going to cover for buying a primary residence that'll be the next best thing instead of conventional. But we always want to start out here. Best loan programs available for investment property financing, I covered that. Minimum down payment options on primary residence, I covered that. Low mortgage insurance costs with less than 20% down. When you put less than 20% down on a property, you have to pay what's called mortgage insurance. The only loan that does not have mortgage insurance with zero down is a VA loan. I'm going to cover that in a minute. Okay, if you serve our country, you really do get the best loan, and you should. But we're going to cover that in a minute. If you're not a vet, though, minimum down payment loans, less than 20% down, have to have a separate company insure the loan. That's called PMI insurance, mortgage insurance. When your credit is above 780 mid score, your PMI insurance is extremely low on a 5 or 10 or 15% down loan. It's above 760, it's still very great. Above 740, it's still good. 720 to 740, the mortgage insurance starts to go up quite a bit, but still lower than an FHA loan. If you're at 700 and below, then the mortgage insurance costs with minimum down payment start to be as high, if not higher even, than FHA. So that's another reason why we start to, put other programs in front of you if your credit score is not as high, because those other programs start to actually be better. And then, again, astonishing, Fannie Mae now will lend to $1.581 million on a 4-unit property. So you can go buy, a $2 million, $2.5 million property, fourplex, and let's say in Orange County, for example, and you can get a $1.581 million loan amount for that. This is available on investment property and on primary residence, and the interest rates are phenomenal. We're probably 2.875, for a 4-unit purchase on a primary right now. So it's just phenomenal. The rates are just so good right now. And again, you can go to $1.581 million. Here's the history of the Fannie Mae loan limits. It does go much deeper than this, but I wanted just to kind of touch on 2003 through 2021 so you guys can see when we had gone into our recession and hit around 2008, they hadn't really changed the loan limits, right? They kept everything at 417 there for 3 years. They only really started raising them when we had this big housing boom that happened in the early 2000s. So you see it went from 322,700, they raised it a couple percent, then they did the same thing in 05, and then all the way from 2006 to 2016, we were at a $417,000 max loan amount that Fannie Mae would lend on. Fannie Mae and Freddie Mac are both basically owned by the government, right? So this is the government essentially allowing these lending companies to do what they're doing. So when we started to see them raise the loan amount limit in 2017, 18, 19, that was because the economy was healthy again. The jobs had come back. We were at 10% unemployment in 2010. We were at about 4% unemployment in 2018. Okay, and in 2019, we were all the way down at 3.6% unemployment. Okay, and they keep on raising it because believe it or not, the underlying view of the economy right now is it is still pretty strong. And I'm going to cover that a little bit later. Again, these max loan limits, so you could see them. The max loan limit for a duplex is $1,053,000, and that requires a 20% down payment. You can also do 20% down now. Excuse me, that's on a primary residence. If it was a investment property, it would require 25% down for a 2 to 4 unit property. But on a primary residence, you can go 20% down to $1,053,000 loan amount on a duplex. You can go all the way to $1.272 million for a 3-unit property, and then again $1.581 million for a 4-unit property, and that requires 20% down. All of the 2 to 4 unit financing for investment properties always requires 25% down minimum. Okay, so what guidelines have changed back to the pre-COVID-19? So rental income updates. During COVID, we had to get bank statements for basically like the whole year to verify that the tenants had not missed any of their payments. Otherwise, we were not able to use any rental income on your properties to offset your debt to income ratio. And I'm going to cover that on another slide here in a minute to kind of show you guys how that works. Because you might be going, well, if I start buying all these properties and I already have this amount of debt on my credit, I'm going to blow past 49% debt to income ratio immediately. No, we can use 75% of the rental income to offset debt to income. So I'm going to cover that in a minute. But again, if you had any tenants that were not making their payments every single month, you were not able to use that income. Now that's not an issue anymore. If they missed a payment or whatever, we can still get rental income from that property. If you're self-employed and had declining income in 2020, but your income is rebounded in 2021, we can now use a 2-year average again. During the heat of COVID, really before the vaccine started to get administered, was when we were still in the heat of COVID. I call last Christmas just the heat of COVID. If you had any declining income year over year at all, any declining income, then we could not get the loan done self-employed. And that's now gone. We can now use a 2-year average again if your business has rebounded. So really, really great news. Verification of employment is performed 4 times through the process. So we had to verify your employment 4 separate times throughout the process. We now only need to do it 2 times, in the beginning and in the end of the loan process. So definitely stay at your current job if you're in the middle of a transaction. If you're going to leave jobs, that's okay also. Try not to do it in the middle of a transaction. But if you're W-2 to W-2 income, we can close on your loan with your new job after only needing 30 days of pay stubs at the new job. We can close. If you go from being W-2 to 1099, you now need to wait for 2 full years, okay? Because we have to see what type of write-offs that you're going to take. So if you're going to become self-employed soon, definitely buy your house or start buying your properties while you're W-2 and do that, and then go to being 1099 if you're going to start a company or something like that. Also, if you're Schedule C and not incorporated, you must show 5-year history for work. So you have to show that you've been doing, basically if you're self-employed but you don't have a corporation, we needed to have 5-year work history. Now you're back to only needing 2 years of working in that business or having that income before we can use the income. And then debt to income ratios for W-2 borrowers, still the same. We can go to the 49.99%. And if you're self-employed, that was lowered to 45% during COVID. Now it's back at 49.99%. So they've loosened up there. It's great. Investment property financing now requires 20% down minimum. That was during COVID, but now we can go back to 15% down. So that is now available again. You can buy with 15% down. I have a client that can only take $50,000 out of their 401k, and they really had enough for about a 15% down payment. They're fine with the payments, and they're going 15% down. So some clients do the 15% down program, but again, I really do advise 20 to 25 minimum. And then 12 months reserves were required for first-time home buyers. You now only need 6 months reserves. What reserves are is it's the monthly payment for the home that you're buying times 6 months. And we want to see that you have that amount of money left in your account after closing. So it's not money that's being used for the transaction. It's money that's going to be there after the transaction is complete. and we want to see that you have 6 months of monthly payments in reserve for all properties owned, excluding the primary residence. So a little bit about VA loans, just phenomenal loan program. You see here, primary residence only. There's no mortgage insurance on VA loans, so you can go 100% financing with no monthly mortgage insurance. You can go all the way to 56.99% debt to income ratio, so you can go quite a bit higher on your debt to income ratio for a VA loan versus, remember, conventional was 49.99%. You can be W-2 or self-employed. And then there's no longer a cap on VA loans. I know that my company internally caps us at $5 million, but you can technically do a $5 million purchase with no money down and get a VA interest rate, which is probably mid-twos today. Okay, that's phenomenal. The CEO of Marshall Reddick and one of his top agents and myself did a VA purchase last year together for a client in Newport Beach. It was $2.2 million. Did it with 100% financing. Got a at that time he got a 2.375% VA 30-year fixed rate with no mortgage insurance for $2.2 million. Also, if you're a disabled vet, you do not have to pay a VA funding fee. The VA funding fee is 2.15%, and it goes a little bit lower if you put more money down. But just average that out. 2.15% of your loan amount is the funding fee that VA charges. But if you're a disabled vet, there is no VA funding fee. He happened to be a disabled vet. So he got that loan with no points at all, nothing financed into the new loan, a low 2% 30-year fixed rate with no mortgage insurance, 100% financing for $2.2 million. Just phenomenal loan product, phenomenal. FHA financing, they'll go to the same debt-to-income ratio as VA. So it's usually, like I said earlier, that if your credit scores are lower, where conventional doesn't really make as much sense, then we will go to an FHA loan. What's pretty cool about FHA is they allow duplex financing on a primary residence with only 3.5% down. So you'd be surprised how many times that I've done that loan. I've got probably 2 of them in my pipeline right now that are closing in the next 30 days. So duplex financing with as little as 3.5% down. If your credit is excellent and you have a great job, but you're younger, you don't have a ton of money saved yet, but you really want to buy a duplex and live in one side and rent out the other and turn it into an investment property in the next 2 to 3 years and then move into your next house. I have clients that have a 780 mid-score, but they're doing a 3.5% down FHA loan on a duplex because they have to put 15% down on a conventional loan. And to get to that high balance loan limit, they'd have to put 20% down. So this allows them to be able to leverage into a great property with only 3.5% down. You can also refinance that loan onto a conventional loan once you've got the equity in it. So, this is a great strategy for starting your portfolio. Or even if you just want to put minimum down and buy a duplex and live on one side. Loan limits for FHA financing are the same as conventional, although in some areas FHA doesn't go as high as conventional does, but they're all based on the same max loan limit. So they will go as high as conventional depending on the area. And then you can get a loan done on a FHA loan with as low as a 580 minimum credit score. The pricing is best at 640 plus though. Doesn't even change. If you're above a 640 mid score, FHA pricing is the same all the way to an 800 FICO score. Jumbo financing. So jumbo loans are any loan in the entire nation, depending on the market or how high conventional will go, but anything above $822,375 is going to be considered a jumbo loan. You can actually go minimum down payment again on jumbo. I'm going to cover that on this slide in a second. But yeah, so any loan amount above $822,375 is going to be considered jumbo. Minimum FICO score requirements is 700. 12 months reserves are generally needed, although that was during COVID. What we're seeing now is we can get them done with only 6 months reserves. So as the economy has gone through this pandemic, we're still not through it, but as we've been going through it and after multiple vaccines are now out there and being administered, and as we're making progress, lenders are loosening up again. This is an example of it. We can get a jumbo loan done with 6 months reserves now. Depending on credit score, you may need 9 or 12 months, and we'll cover that with you when we get you pre-approved. The max debt to income ratio for a W-2 borrower is 43%. It was pushed to 35% during the heat of COVID, and now it has changed back to 43% again. So we can do a jumbo loan now, self-employed, to a 43% debt to income ratio. And the rates were also a little bit higher for self-employed during the heat of COVID, whereas now self-employed and W-2 will have the exact same interest rate. It's based on credit score, again, completely. And 20% down payment was required during COVID. We could do 10% prior to COVID. We now have 15% down available. It's a Chase product. We sell the loans to Chase on all of our jumbo that have that 15% down payment. I even think that they're going to up that or increase that. I think 10% down jumbo will be available, and it's probably even available now going directly to a Bank of America or a Wells Fargo or something like that, depending on if you have like a lot of money with them and just a really strong file, they might do 10% down. So that's definitely coming. I love to throw this in there just because it's fun. This was me at 19. Actually, that was 20 in this picture, I think, because I've been working for maybe a year and a half already. This is at one of our old club meetings when people would come around and ask questions and buy property, and just super, super cool. It's just unbelievable that so much time's already passed. But yeah, I've been doing this a long, long time and just love what I do. Very important note, okay? If you own real estate and if you participated in forbearance, okay, we were trying to find out what was going to happen, what was going to stick, because during the heat of COVID, lenders, they didn't really know like how they were going to penalize people, or if they were even going to, or if they even could. And now that a lot of time has gone by, we've been able to see how it's going to affect you if you do forbearance. If you've done forbearance, if you pay it back in full and reinstate your loan, then we can get you qualified on a conventional loan right away. On a jumbo loan, it's a little bit more tricky. Usually we have to see that you've reinstated your loan and already made 6 payments since the reinstatement. But I believe that they're also going to change that soon and allow you to do jumbo right away once you've paid it back. But if you're currently in forbearance on any of your properties and you want to go buy another property, you will have to pay back the full amount that you owe and get the loan reinstated. You do that by calling your loan servicer, and then you'll be able to qualify to buy a property. So just know that if any of you are in forbearance, you'd have to pay that back. Couple notes here on just how to close your loan a little more smoothly. Try to maintain employment at your current job after you're in the process. After you get pre-approved. Keep all existing credit card accounts open. Don't pay off anything unless we tell you to, because if you pay off all your accounts, it actually, depending on the type of account, it can affect your credit scores. Pay off any collections, judgments, or tax liens reported within 1 year. Stay current on all existing accounts and financial documents, and always call us with any question. And, things that we don't want you to do is don't go out and buy anything else while we're in the process of doing your loan. Don't go buy a new car. If you have to, let your loan officer know, and we'll work that out. But just be aware that opening up any new credit, buying a car, trying to buy another property, the lender's going to find out about it. They do credit pulls like soft checks throughout the process. And if you open up any new debt, that can affect you. If you go put a bunch of money on a credit card and now that payment's a lot higher, the minimum payment's a lot higher, we're going to find out about it by doing soft pulls throughout the process. That could push your debt to income ratios too high, above that 49.99%, and now you don't qualify unless you pay it off. So things like that, if you have to do any of these things listed here, just call your loan officer and talk to him about it first before you do it. So down payment requirements, okay, for 1 to 6 properties, you can do a 20% down payment. Based on a 660 FICO plus. So you want to be above 660 always. You really want to be above 720 is where the pricing is really good for investment properties. Anything above 740 mid-score for conventional loans, the rates do not get any better. So if you're thinking that because you have an 800 that you're going to get a better deal, it's really not going to make a difference unless it's like a jumbo loan. The only product that will give you a better rate is jumbo if you're above 740. Everything else is based on 740 max. And then 2 to 4 unit properties, They always require 25% down. And then the 1 unit always requires 20% when you go to 6 properties or less. For your 7th through 10th finance property, 1 unit property and 2 to 4 units, we actually just got this updated internally. We can now do 20% down all the way to 10 finance properties. We also can do 25% down all the way to 10 finance properties. So your 2 to 4 unit, you used to have to put 30% down and have a minimum credit score of 720 plus to buy your 7th, 8th, 9th, and 10th. But now we don't need that. You can do the minimum down payments. You just have got to have a 720 FICO score. That is mandatory. Again, I just kind of covered this, but you'll need a 720 FICO score to get to 10 finance properties. As long as you're paying all your bills on time and as long as you're keeping your credit to limit ratio low. So if you keep your credit cards below 10% revolving each month, and you pay all your payments on time, mortgage debt is good debt. So as you acquire more properties, you're going to see a stronger credit score. So you should be fine to buy up to 10 finance properties over time and have a great credit score as long as you're making your payments on time and obviously keeping those credit balances low. Must have 6 months of PITI in reserve for each property. PITI is principal, interest, taxes, and insurance. And then rental income can be used to offset the monthly payments. So before a property is on your tax returns, let's say you bought a property 3 months ago, we can use 75% of the gross rental income. So if it's bringing in $2,000 a month, we can take $1,500 and add that onto your income if the property is leased. In most cases, that will more than cover the principal, interest, tax, and insurance and the expenses of that property. The property pays for itself. Once a property is on your tax returns, we have to go off the amount of rental income that you're putting on your tax returns. You don't just get a flat 75% anymore. So make sure to always claim your rental income correctly on your tax returns. If you have these expenses that we're talking about, you're still probably going to have your CPA able to write you down to where you're not really showing any income on these properties, even with the full rent. Maybe a little bit of income is going to be on there. And as you own the property longer and you raise your rents over time, then obviously, you're going to have more positive cash flow on there that you're going to have to claim. But you definitely want to claim all your income if you're trying to build your portfolio. I guess once you get to 10 finance properties, it's up in the air, but I think you should always file correctly, and you definitely want to file all that income so that you can use it to keep on building your portfolio. Another thing you need to know to get to 10 finance properties, you can have multiple other loans, like private loans, but you can only do 10 conventional loans total, and that does not include your primary residence. So if you had 10 rental properties that all had conventional loans, and then you want to go buy a primary residence, you could still get a conventional loan, no problem. It is not going to count. So really you could have 11 finance properties if you bought your primary last. Or if you sold your primary and you had 9 properties, and then you buy one more investment property, and then you decide, okay, honey, now we're going to go buy, a new primary residence, you can get to 11 finance properties. Also, each spouse, if they file tax returns separately and each have their own really good income, and they each have their own assets, you can each buy 10 properties separately to build a 20 property portfolio. And then you could always put everybody on title once you get there to your 20 properties and maybe put it all in a trust or whatever way you want to do it. But we have clients that have done that. I mean, I have a client that's a doctor, both of them are doctors, and they've both bought 10 properties over the years each. So it's pretty cool. And then once you get above the 10 properties is when you'll want to use Marshall Reddick's private lending, and I'm going to discuss that in just a minute. And then for these types of loans, 15 and 30-year fixed are the only options. Now, I just learned something pretty amazing about my company. We will allow you to refinance a loan anywhere between 20 to 30 years. We will allow you to refinance. Let's say you've already been paying on your loan for 4 years. You don't want to recast it and do another 30-year loan. We could do a 26-year refinance. We could do a 23-year refinance where it's amortized over 23 years and just bring down your interest rate. It doesn't have to be a new 30-year loan again. Also, anytime that you're with my company, we service all of our loans. You can call in and say, hey, I want to pay down my loan by $100,000 and have it re-amortized. We can do that. We can recast your loan. It's like $400 to do it. So pretty cool stuff. And I didn't even know this actually until today. My loan officer, Lisa Nesper, enlightened me on it, and I was blown away by it. I mean, you can literally do a 23-year loan if you want, and just to bring down your rate. So pretty cool. Okay, how do I purchase if I can't qualify conventionally or I have more than 10 financed properties? Okay, some people make amazing money self-employed and they just write everything off, and that's okay, but you're not going to be able to get a conventional loan. If you go to marshareddick.com, click on the Borrow tab, and then click on the Private Financing, you'll be able to see all their loan programs are right there. And I know of nobody that has interest rates like this for private money. The way that they underwrite is exceptional. They have such a low default risk that they are able to lend money out cheaper than anybody that I have seen on private lending. So if you don't meet the conventional criteria, definitely check out Marshall Reddick, click on Borrow, and look at their loan programs. Some frequently asked questions. I already covered this, but again, we can do the 75% of gross rental income. We can take that and add that onto your income towards qualifying. And then how do you factor the rental income if the home is not pre-leased? When we do your appraisal, it's an investment property appraisal. There's going to be rental comparables on that appraisal report. They generally have to get 5 separate properties near your location and put what they rent for. And then we take 75% of the projected average rents in the area, and then we can use that towards your debt to income ratio. So property does not need to be pre-leased when you buy it for us to use that income. Okay, so I'm going to switch gears a little bit, do a little bit of a market update, and just kind of, go back in the past a little bit. I love this slide. A lot was happening back in the early 80s to push interest rates to 18.45%. The Volcker Act was put in place to basically slow down growth. You had, moving up into this in the late 70s, there was an extreme shortage of oil, and oil back then was mainly the only energy resource that we had. It was really fueling the entire economy in so many ways, all the way down to goods that we make, to make lumber to build houses. Everything took oil, okay? And when we got into the late 70s, there was an extreme shortage of oil. And then the Yom Kippur War happened, and then OPEC shut off the entire world to their oil resources. And that just caused the cost of oil to spike so high that the Federal Reserve had to raise interest rates, I think 20 times, okay, with the Volcker Act to slow down growth. And then as oil started, everybody started kind of pumping again. As we got into like the mid 80s, things started to loosen up a bit. And then we went back down to about that 6.67% average. But my dad was buying property in the early 80s in San Diego. And it's like, yeah, I remember I had an 18% interest rate. He also had a 10%. He was getting 10% at his bank in a CD. Could you guys imagine a CD that paid 10%? It's just incredible. So everything's going to be relative to its environment. Where we're at today, this chart unfortunately only goes to 2014. We're back down in the high 30-year fixed rate range again. So unbelievable. A lot of that has to do with COVID. I'll cover that on the next slide. But just to remind everybody that historically rates have been about 6.5%. And so when you look at how cheap money is today, that's another reason why people are buying property. They know that it's possible this is not going to continue to last. Okay, so what have rates done since COVID-19 struck? So this looks like a different language. I'm going to break this down though completely for you. This is the Fannie Mae 2.5% coupon, okay? It's the most closely traded mortgage bond in relation to the loans that you guys are applying for when you buy an investment property or when you buy a primary residence. And Jumbo and FHA and VA kind of beat to the same drum. So this is the most closely correlated with home loans, with full documentation home loans. Each one of these little lines is 1 day of trading Monday through Friday, okay? Bond market, every single day is during the week is going to be moving except for holidays and obviously weekends. Green is investors buying the bond, causing the bond to appreciate which drives down the yield. Rates actually get better. When this goes up, it's appreciating and it drives down the yield. The rates go down. Red is investors selling the bond, causing the bond to depreciate, which drives up the yield. It's like supply and demand. If less people are holding it, then the rate of return needs to be higher, so people will buy it. And who's buying this type of bond? They're sold in $5 million bundles. Who's buying this bond is central banks, right? Our own government is buying $50 billion a month in this security right now. Right now, they're buying $50 billion a month. You know, they're doing quantitative easing to keep rates low till we get through COVID. You know, and so every single day, this is what affects your interest rates. That's why rates are not the same every single day. So this is a view from March of last year, or right before March. So you can see all the way through COVID what's happening, and I'm going to break this down for you. These little lines are the moving averages, the average where the rate has been within that particular time. Okay, the 10-day moving average is the little green line that you can see embedded in there. The 25-day is this light blue, the 50-day is the dark blue, the 100-day is the pink, and the 200-day moving average is the purple line. As you can see, we've just been riding this slope up as investors pulled into bonds when COVID started. And then we had this amazing reaction where everybody was a flight to cash and everybody was selling bonds, anything that they could, these big companies especially, because they had to move into cash. We didn't know how long we were going to be on lockdown. We didn't know how much capital that you would need to get through that. You know, so everybody sold everything right when we went into lockdown, and then it obviously went to the best rates of all time. So the first highlight is right when Donald Trump he stopped downplaying COVID a little bit. He said, you know what, actually, I think this is going to be serious. And as a result, bam, we hit the best level of all time just right after that. Then we worsened a little bit. There's a lot of propaganda and stuff going on in the news, and you just didn't really know quite what was going to happen until we went into early March, and they started talking like, you know, we're going to shut stuff down. Like, this is big, you know. You started seeing these massive drops in the stock market. It's unbelievable how big some of these drops were. I remember one day it dropped like 3,000 points in a day. Unbelievable. Never seen anything even near it. It's incredible. Not in a good way. So the second point is when COVID really became a big deal. And you can see we went all the way up to that very, very top line. This is when the Fed lowered rates the first time. They didn't drop them immediately down to zero. Okay, so we got to the best rates of all time. Then the next couple of days were unbelievable. I mean, on top of COVID, you also had this big oil war that started between Russia and OPEC and all this crazy stuff going on. I turned on the news and oil was down like 25% in like a day. It was like, whoa, this is insane what's happening, right? And then we had that flight to cash. After that happened, it was like everything got very, very real for everybody. And it just started, just big central banks, everybody dumping stuff, moving into cash. Rates seesawed and got really, really bad, actually. I think it went to like a 3.75 from like a 2.5 in like a week. Then this third line, okay, when we kind of recovered through it, and this all happened pretty fast. Look how many lines this is. This is maybe like within 2 weeks this all was happening. That's when the Fed decided to drop the rates to zero. Okay, when they did that and when they started coming up with all these lending facilities and broadcasting it all over the news, and we knew, okay, the Fed's going to come in, they're going to help small businesses all the way to large businesses, create all these lending facilities, keep rates at zero, like, okay. And then that's when the bond market went absolutely crazy, and we got all the way to the 105 level. Look on the left-hand side, you see 105, 04, 03, 02, 01. We used to trade off like the 95, 96, 97. So anything, we were already at amazing pricing like in the summer of 2019. Rates were unbelievable. They were at an all-time low. Why they had got there is because the stock market had been chugging along for a long time at all-time highs. Tax reform had happened. There hadn't really been a big economic disaster since 2008. And people were just starting to go, something's going to happen. So that's why bonds started to become a very big safe haven again, even before COVID ever even happened. But now going to COVID, we're up at 100, 101, 104, 105. So that's when we hit the best rates of all time, right after the Fed lowered us to zero. It didn't happen, though, right away. It took a few months, actually. As the economy, as we got through COVID, as we got through the lockdown and started to reopen the economy again, more and more money was just piling into bonds. And this fourth highlight is when we got the absolute best rates of all time. I think we were like a 2 3/8 30-year fix with no points. That was pretty short-lived, 2.5. Some of you on the call may have refied on a 2.5% 30-year. Yeah, so just unbelievable how low that they got. Then you keep on chugging along, and this fifth highlight is right when the vaccines started to become administered. We had the presidential election behind us. All that volatility was now just starting to leave the market. And the vaccine rollout was really fast. I mean, it was pretty good. And regardless of what the news told you, it was pretty good. It was pretty quick. And so there started to be this fear because not only our government buys these bonds, other investment institutions buy them. You could look in your 401k and you might see that part of your allocation is in Fannie Mae, Freddie Mac bonds. So lots of people buy this. Well, what you don't want to have happen is rates start to go up dramatically and you have a ton of money in this, because the yield of your security is going to be much lower than the market. So it'd be hard to sell it. You'd have to discount it dramatically to be able to sell it, or you have to have rates come back. Okay, so that started a pretty big sell-off, and we saw it right around, I think it was like end of February is when it started to be, the 10-year note went back up from being like below 1% to like 1.6%, and it happened very, very quick, and it definitely shook the tree. And so that's why you saw rates go up quite a bit back in like March. I mean, March, April, they started to go up again. They actually went all the way back to like a 3.5% average 30-year fixed, and then they started to creep back down again. What we're seeing today happen, COVID, bond traders, big institutions, the government, I think with Delta variant coming out, it's finally settling in that this is probably going to be here for some time. It's not going to evaporate in the next 3 to 6 months. Bond buyers make their actions based on 6 months in advance. The stock market trades daily, but people that are buying bonds, when they do this, they're buying against where they think the market's going to be 6 months out or even longer. And I think why you're seeing interest rates get really, really good again, there's a lot of reasons, but I think the biggest underlying reason is, we don't have our masks on in most states anymore. We really do want to forget about COVID-19. I think everybody does, right? And for anyone that's had personal family members or friends die of it, I'm so, so sorry, and it's just terrible. It's really, really terrible. The fact is, though, people are understanding that it's going to stay for a while, and the Delta variant is a great example of it. We're probably going to be dealing with this for the next 1 to 2 years, not the next 6 months. And when the vaccine rollout was so quick, and it started to make such a big impact on the numbers, there was a flight out of bonds. But now that the dust is settling, and we're seeing that it's probably going to be here to stay for a while, that can affect the growth outlook. That helps bonds. Bonds don't like growth. Bonds don't like the Fed raising interest rates. Bonds want the Fed to stay at zero as long as possible. So even though we've had 3 months of insane year-over-year consumer price index growth, right, where the cost of goods have gone up a bunch, and a lot of that just has to do with supplies, right, and just with supplies being down and taking longer to get things. It will work itself out, but the point is that the really big underlying factor here is that COVID is still here. So we just have to be mindful of that. We have to be careful. And on the flip side, the positive is that interest rates are going to stay low, I believe, for some time. The last thing I want to touch on is employment. Prior to COVID, we were at, like I said earlier, a 3.6% unemployment rate. We also had 6.8 million unfilled skilled labor jobs. The JOLTS report comes out every month. It's the Job Openings and Labor Turnover Survey. You can Google that and read about it more. And it showed 6.8 million unfilled skilled labor jobs, best reading of all time before COVID. That's how that's how much that our employment market had improved. Today, unemployment is just under 6%, and we have over 9 million unfilled skilled labor jobs. I believe a lot of people will be going back to work when they absolutely have to, which I think that the government, is probably going to start easing on a lot of what they're doing, probably around October of this year, depending on COVID. But the point is, there's a lot of people that are not back at work. There's a lot of jobs that are available for skilled labor that they need to fill. And for the Fed is looking at employment. That's what they care about the most. People's safety and then employment. And when they see the fact that there are that many unfilled skilled labor jobs and we're still at 6% unemployment, they're going to need to see that number come down quite a bit before they even touch their federal fund rate. And this insane price spike in goods that we're seeing, it's going to calm down. It absolutely will. You've already seen lumber come down dramatically. You're going to see this congestion start to kind of loosen up, and it's going to be working like clockwork again, but it's going to take time. So the mixture between COVID still being a big deal, really it is, the different types of variants that we can expect to see probably next year, it might be another. I mean, this is like the flu, right? A bad flu. There's always a different flu coming out. Well, because it's got the word COVID associated with it and it's very serious, you're going to see that probably be an issue for the next 1 to 2 years. That mixed with jobs, that is why interest rates, I believe, will stay at or near this range for a very long time. This is just a short view so you guys can see. This is the Fannie Mae 3% coupon. This is what we were trading on, the 3 mainly before COVID happened. You can see that earlier this year around February, we were at the best range. And just like I just talked about, we bounced around for a while, and then now we're already appreciating back to the best levels. But now we're trading off the 2.5 and off the 2% coupon. So this doesn't have quite as much correlation anymore. But just a view for you guys to see again that interest rates change daily, and we are now floating back to those all-time lows because of what I just discussed with COVID and with employment. Now, why are interest rates important? Every 1% rise in rate is a 12% increase in your monthly payment. That's the math. So if something is 3.5% versus 4.5%, it's costing you 12% more in monthly payment. So rates are very, very important. This is my weekly market update. For anybody that wants to be added on it, just send me an email, and my operations manager, Samira, will have you added on right away. Goes out every Saturday. I've done this for years and years and years, and I love doing it. And it's very, very important to stay on what's going on in the economy, what's going on with interest rates, not just what CNBC is putting out there, Bloomberg. A lot of them have their own agendas. This is just data for you to review, and it goes out every single Saturday. So if you guys want to be added on that, just let me know. Just a quick plug about my company so that you guys understand why CMG. Largest privately held mortgage company. We're able to make decisions very, very fast. We have one single owner. His name's Chris George. He's amazing. He was the chairman for the CFPB for a very long time. He's just a great guy, really, really knows his stuff, and he's managed his company very, very well. We're licensed in all 50 states. We are a purchase lender, so we can obviously move very fast. Bank rates with lender service. I mean, I'm right at the best banks rates all the time. We did over $30 billion last year in loans too, so I think we're number 11 in the whole nation. So we are a very big company, but we haven't lost the lender service that you need. I have my own underwriters, my own doctors, my own funders, all of my own staff. I operate like a company within a company, so I can move mountains. I can do 5 deals at the same time in multiple states. You try giving that to a Bank of America, it's a nightmare. So again, but we have the bank rates. I don't have high rates. I've got amazing rates. Also, investment property and second home financing. Many of you can Google this or you've seen it that, the rates have gone up a lot for those types of loans. Because what happened was Fannie Mae and Freddie Mac put out verbiage that you can't, more than 6% of all the loans that you originate, 6% cannot be second home or investment properties. So what companies have done is they've had to raise their investment property rates to slow down foot traffic to make sure that they're only allocated within that 6%. My company has not done that. My company personally, because I am in the top 5 in the whole company, and they know that I do about 50% of my loans are all investment properties, they purposefully have kept my investor rates extremely low. They're amazing. I'm at like a 3.375 30-year fixed investment property rate today with no points, with 25% down. Some lenders, a few of them are probably just like me, but there's very few. Most banks are up in the 4% range now for investment properties. So that's a huge one. But yeah, bank rates with lender service. It's very, very hard to find that. We specialize in investment property financing, and we're also a loan servicer. This to me is huge. After your loan funds, my operations manager, Samira Hurd, she's there. She sends you your first mortgage statement. She shows you how to log in to make your payments online. You have your own CMG dashboard. My last company I was at, we didn't service any of our loans. And I didn't like that because what happened is they'd sell the loan multiple times, and my clients would get irritated because they're always having to reset up their auto pay and deal with that stress of having your loan sold. And so here we don't sell any of our conventional loans, which is just phenomenal. So we're going to be here to help you even after the loan closes. If you have a problem with your mortgage payment getting made or something like that, you just email us. We get on it right away. If you want to add tax and insurance impounds after the fact, we can do that. If you want to recast your loan, like I talked about earlier, because we're the loan servicer, we can do that. So just having your company service your loan that actually did your loan is just amazing. A couple things about us, just online reviews and whatnot. Al Rodriguez is my business partner. He does do some loans within Marshall Reddick, so you may or may not talk to him. Lisa Nesper is my sidekick. She's phenomenal. She's been in the business for 35 years. She's just a wealth of knowledge and great at what she does. And then obviously myself, been doing this for a long time. That's going to conclude the presentation for tonight. I really hope that you guys got a lot of information and took some knowledge with you. My heart goes out to all of you. I hope you're staying safe and healthy and that your families are healthy and safe. And we greatly appreciate you guys here at Marshall Reddick and at CMG Financial. You guys call me if you need anything. I'm always available. My website's right there. It's reedhazard.com. That's my number. And yeah, just definitely talk to Thomas. We're going to be doing some scheduled follow-up calls as well. Lisa and myself will be reaching out to some of you guys that are on the call just to say hello. So we'll be doing that over the next few days. And yeah, just if you want to schedule a consultation or you need anything from me on this end, you can always call or email me anytime and I'll be available. And yeah, just thank you so much for letting me speak tonight.
Perfect. Yeah. I always love listening to you, man. It's always a wealth of knowledge and you always learn something new. And it always suits my clients even better, just hearing all those new programs, what you got going on. And it always is a pleasure, man.
Thank you so much. Appreciate it.
Well, yeah. Well, I guess same thing from our end too. We're going to be scheduling consultations. We'll be doing reach out calls and everything like that. You can reach out to us here on the Marshall Reddick end as well. You can go to marshallreddick.com/consultation to schedule a consultation, or you can reach out to me directly if you're looking to, looking to acquire properties or any other services we offer here, property management or anything like that. So yeah, again, always a wealth of knowledge. Thanks again, Reed. I greatly appreciate it. Thank you everyone for finding time out of your busy schedules to join us tonight. And we'd love to help you achieve your real estate investing goals. Thank you.
Awesome. Thanks, you guys. You have a great night.